This year, we use a whole new way to do this event. First of all, we live webcast the afternoon program online. So as you can see from the screen of your left-hand side, so maybe you can raise your hand and say hello to the audience online. And secondly, we use the Chonghua Dianxin technology to do a interactive video conference with our first speaker, Niles, who is based in California, but who is not able to fly over to Taiwan today. We believe this is a good example showing how our life is changed and enabled by semiconductor. Okay, hi Dan. Can you hear me?
Hi, how are you?
Good.
I can hear you. Can you hear me?
Yes. And
okay, great.
Would you like to give us your presentation of the economy view of the semiconductor industry?
I would love to.
Okay.
So when Jody had me prepare for this, what she wanted me to focus on was the effects that things outside the semiconductor industry, so factors from the global economy, would have on the growth of the industry. Obviously, the report that she put out is excellent, and it really gets into the importance of semiconductors in the global economy. But obviously, the global economy has a lot of impact on the semiconductor industry as well. We saw that with the recession in the late 80s, with the bursting of the tech bubble and the recession in the early part of 2001 and 02, and obviously most recently in 08. So what this presentation is really going to go through is talk about what I see going on with economies around the globe, what kind of impacts that's likely to have on the IT spending, and then on ultimately semiconductors. Now, as the title of this presentation refers to, I think, unfortunately, we're potentially entering a fairly dangerous and volatile time for the global economy. And the big thing is that quantitative easing, which has been going on in the United States really since 2007-8, that's going to be coming off actually this week. And then we're going to have to see how things evolve from that period in time. So going to slide 2, what you can see here is really that, we're at a very interesting time in that there's a lot of political uncertainty, obviously, with things like ISIS, for example. Commodity prices are very volatile right now. Oil prices obviously dropping pretty precipitously. Housing market in China, for example, is a worry point. Unemployment in Europe is a problem. We talked about the fact that credit is going to fall off here with quantitative easing going away in the United States, and then really what is the direction of interest rates going forward. So all of these things are really moving, and they're all somewhat interrelated. So what I'm going to try to do is go through and touch on many of these points during the rest of the presentation, and then come to a conclusion as to where we are. So the first thing is, if you look at the U.S. economy, because it is still the biggest in the world, and you look at where we've been, we had unemployment around 10%. And the good news is, since the financial crisis, we've seen unemployment drop to below 6%, and it looks like it's going to continue to go lower. The U.S., out of all the economies, is probably the healthiest in terms of its growth and what the growth rate looks like relative to 6 months ago. And this is a good sign, because without jobs, for an economy that's over 70% of it is driven by consumers for GDP, you need to have people with jobs for them to go out and spend and drive the economy. We can go to the next slide, slide 4. This is the job losses. And what you can see here is that the job losses, which have been running over 650,000, that's actually dropped to very, very good levels. And this chart goes back to the early 1960s, and you can see we're actually at pretty low levels by historical standards. If you go to the next slide, it's great to have a job, it's great to have more people employed, but you would also like to see wages increasing so that people have more money to spend. And here what you're seeing is that wages are starting to slowly increase. They're going up by a couple of % a year, which right now is more than the inflation rate in the U.S., so people have more to spend going forward. Now, if you go to slide 6, the biggest problem most recently in 2008 was the housing bubble. Now, if you look at this chart, and Jody probably remembers this, but I showed this chart to a GSA board meeting back in late 2007, before Lehman, or I think before the big round of bank failures. And what you can see here is that the amount of inventories of homes for sale had gone from sort of a 4 to 5 week range back in 2005 all the way up to about 10 weeks. And this is before the failure of Lehman Brothers in 2008. So if this was the balance sheet of any of the companies you worked at, and these were your inventory levels, you'd be extremely worried. And people should have been in late 07, but they weren't. The good news is now, with several years behind us, we've seen these inventory levels of homes for sale dropping from almost 12 months all the way back down to about 5 months. And so this makes me feel pretty good that the housing market, at least in the United States, is in pretty good shape. If you go to slide 7, what you can see on this slide is that the home sales, so the amount of homes being sold, has also improved. So it was down at about 3.5 million units. This has moved back to about 5 million units. And so this also is a good sign. Inventories are down, sales are up. And then if you go to the next slide, slide 8, this gets reflected in prices. And that prices for homes are now up roughly 12% year over year. So when you look at the U.S., whether it's from an employment perspective or from the housing market perspective, which was the most problematic recently, things look like they're in pretty good shape. And this gets reflected in the wealth that people have. So if you go to slide 9, this is household wealth in the U.S. and how that's changing. And right now, that's increasing roughly at a rate of about 10% year over year, driven both by home prices and by equity prices. So a very good sign, especially as we head into the retail season in the United States, the holidays, when, you know, we want to see people buying a lot of iPads and iPhones and computers, etc., to help drive demand for all the companies in Asia as well as around the globe. Going to slide 10, one thing that can be very problematic is if inflation is running high. And the good news is partly because the dollar rising and partly because there's excess capacity still globally, what we've seen is commodity prices in the U.S. at least are still fairly restrained on slide 10. And this doesn't look like it's going to change anytime soon. And so that's a good thing. Going to slide 11, reflected a little differently. One of the biggest concerns is when the Federal Reserve in the United States is going to start raising rates. And this is an inflation chart looking at different measures that the Federal Reserve looks at, CPI, PCE, both core, as well as headline numbers. And what you can see is it's clustered primarily below 2%. And 2% is sort of the trigger point that we need to watch out for. And right now, the good news is we're nowhere near getting to those targets. And so rates going up should be somewhat restrained, at least in terms of what the Federal Reserve decides to do. Going to slide 12, in terms of looking at the world's largest economy and what it's doing in terms of growth, the good news is these numbers, whether you're looking at normalized for inventory, which is in the green, or you're looking at just the headline numbers, GDP growth is very good, 3 to 4%. No real issues here. Obviously, in Q1, with a very harsh winter in the United States, we had negative GDP, which was, problematic. But the good news is, as the weather got better, things improved, and things have started to grow again. Now, so far, when you look at just the U.S., and if you just focus on that, things look, very solid. If you go to slide 13, however, and you look at the rest of the globe, it's quite a different picture. If you look at the world's second largest economy with China, and you look at the orange, you can see that's China's GDP. And that number, and these are official numbers, but you can see here that it's sort of going down and to the right. India, thankfully, with the new regime in charge there following the elections, things look like they're improving. So you're seeing growth looking like it might be ticking up. But when you move to the BRIC countries and continue with Brazil, you can see here that Brazil has actually officially entered a recession. And if you look at Russia, which is sort of that red line, obviously that's probably going to continue to go down and to the right. The biggest problem, however, in my opinion, is the Eurozone. And the Eurozone is that greenish line at the very, very bottom. And if you look at that line, you can see that it was stuck in negative territory for multiple quarters, and it looks like it's actually going to get dangerously close to going into recession. Germany has already had negative GDP growth in Q2. It looks like it's probably going to be negative in Q3. Italy is already back in a recession. And so Europe, to a large degree, is one of the big concerns looking forward. But you've also got slowing in these other BRIC countries as well that we need to keep our eye on. If you look at global purchasing manager indexes, so these are considered look at the future and how things are likely to shape up. The good news is it's a little bit better in that the U.S., if you look at that red, which is the United States PMI, that number is at extremely high levels. So that's very encouraging. The Eurozone, thankfully, is still above 50, and 50 is considered the cutoff mark between contraction and expansion. And Japan looks like it's improving. Obviously, there was a VAT increase earlier this year in April. Demand dropped off. Looks like it's recovered a bit. And China, at least, is still above 50. And so, though these figures aren't great, at least it's not as bad as it was when you look back in time at what some of these things look like back several years ago. Moving to slide 15, this is a different look at global leading indicators. And you can see here also, and this is a composite, you can see that things have, in fact, here shown that they're starting to weaken again. But the good news is still at fairly decent levels. Now, if you go to slide 16, this is where things start to get a lot more interesting. So the data we've looked at so far, particularly in the U.S., looks very strong. If you look at some of the other economies, they don't look as good. But the question is, how did we get here? Well, the first thing is if you look at the ECB balance sheet, that has been contracting really since 2012. The good news is that this should start to expand again, or it has started to expand again. And so that'll provide, hopefully, a little bit of support to the European economy. The bad news is if you look at this relative to 2007, you can see the ECB balance sheet has gone from about 1.2 trillion or so in size all the way up to 2 trillion. This looks like it's going to expand at least by another trillion based on what we've heard so far, but there's already been a fair amount of stimulus put into the system, and Europe is still looking like it may be on the verge of a recession. So that's something that does have to trouble you if you sort of step back and think about it. Going to the next slide, the growth that Japan's seeing, which is definitely not great, has actually happened despite the fact that the Bank of Japan's balance sheet has expanded at a very, very rapid rate. And you can see the chart here, and you can see this explosion. And the Bank of Japan's balance sheet, just to kind of put it in perspective, is roughly 50%, 50 of GDP. That's an enormous number. The U.S., it's about 25%. So the question you have to ask yourself is, if the Bank of Japan balance sheet at 50% of GDP, this is the best growth we can get, how long can this continue without having some adverse impacts as you have to pull them away? So going to slide 18, this is the cardinal question in my mind, is that the U.S. economy in and of itself is in pretty good shape. The question in my mind is, how will the global markets fare with the end of quantitative easing in the United States. Now, this isn't just a question of what will happen with U.S. GDP. It's also a question of what will happen with currency prices around the globe, and also what's going to happen with interest rates. Because if U.S. rates are moving lower, it tends to push other rates lower with it. So if you go to slide 19, what's happened in the U.S.? Well, before the financial collapse, the Federal Reserve's balance sheet here was less than $1 trillion. Today, the Federal Reserve's balance sheet is $4.5 trillion, so roughly 25% of U.S. GDP. Now, what has this done? If you go to slide 20, you'll see here that rates in the United States are at 2.2%, or about 2.3, which seems low, but then when you look at Japan, you can see Japan's rates are less than 0.5%, and Germany, which I would argue is a lot more risky than the U.S., is at roughly 0.9%. And even countries like Spain, believe it or not, have lower borrowing costs than in the United States. And Italy is pretty darn close. So I think what you've seen is a really big distortion in the rates around the globe. And the question is, what starts to happen if these rates start to move higher? Now, if you think back to 2007 and 2008, you may remember how borrowing costs in Europe skyrocketed in a very short period of time and caused some real concerns around the globe. And the question you have to ask yourself is, with QE starting to end in the U.S., do rates start to behave in ways that are a lot more volatile in the future? Going to slide 21 to give a more historical perspective on what have rates done. This has been the best time to be expanding your business really over the last 30 years. And you can see here in 1980, 10-year yields were about 14%. They've come all the way back to about 2%. It's very hard to believe that rates are going to go any lower from here. And in fact, I would think that what you're going to start to see very soon is rates starting to move up. And so if you've been a company and you've been expanding, you've been able to constantly refinance at lower rates, you've been able to buy back your stock borrowing at lower rates, this is a really great environment when debt is this cheap. We'll see how things look as debt starts to get more expensive. Going to slide 22, the one thing you may remember in 2007 is that a lot of people borrowed money to buy homes. And when that market collapsed, it caused a big ripple effect, not only in the economy, but across the globe. This is a different look at that, which is this is the debt in margin accounts on New York Stock Exchange listed firms. And not only was there a lot of debt increases in the housing market, but you can see here in 2007, there was a big increase in debt used to buy equities. And if you look at where we are today, you can see that, in my opinion, some of that cheap interest rates and expansion of the Federal Reserve balance sheet has found its way into stock prices as well, as you can see by the margin debt levels. So the question is going to be, as that easy monetary policy becomes less easy in the U.S., what kind of ripple effects will we likely see in terms of stock prices and or home prices? Going to slide 23, this in the green, this is the U.S. stock market, the largest in the world, and the orange is the price to earnings ratio. And the good news is the stock market's gone up a lot. The bad news is a lot of that has been driven by multiple expansion. And so the question is going to be, as the U.S. economy stays hopefully at these same levels, but as Europe has slowed, as Germany goes into a recession, what we're seeing in Brazil already in a recession, Italy in a recession, China growth slowing, how is the stock market likely to behave, especially when you consider the margin debt levels we saw earlier, which have been really driving stock prices. Switching to China on slide 24, this is an example of what can potentially happen as the Fed starts to taper. Now, you may remember in 2013, the Federal Reserve in the United States started talking about tapering. And we had at that time what people call the taper tantrum. And this is an example of what happened in China in terms of borrowing costs as measured by Shibor. It went from about 3% to over 8%. And you can see what happened to the Chinese stock market over that period of time. And this is before the tapering even started. And so this is an example of the extreme volatility that can catch people off guard, because we've never seen this in the world before. We've never had this kind of stimulus globally. We've never had to pull it back. And so this gives an idea of one of the things that I'm watching on a daily basis going forward. Going to the next slide. The good news is that as the yen depreciates, this has helped drive the stock market. So the yen is in the green, the Nikkei is in the orange, and it's really hard to tell the difference between the two of them. What you should be watching, however, at the same time is the red, which is the interest rates on the debt, which is at 0.47%. And if that starts to increase for a country that's at about 200% debt to GDP, if borrowing costs start to go up, this becomes a lot more problematic. So this is something you should keep your eye on. And again, you can see in 2013, the red, which is the borrowing cost for Japanese debt, moved up pretty substantially during that period of time, just like you saw in the chart for China earlier. Going to the next slide, 26, in terms of Brazil, similar situation, 2013, you can see how the green, which is the Brazilian currency, depreciated quite rapidly in that spike. And at the same time, you can see how the Brazilian stock market dropped off, which is the orange. And again, as you can see here, the elections weren't viewed favorably by the global currency markets, and you can see the real starting to depreciate further and the stock market dropping, which certainly isn't going to help their economy or its contribution to global GDP. Going to slide 27, this is probably the most somewhat encouraging of the BRIC countries, in that the rupee in India is in pretty good shape. It looks like it's not depreciating any further. The stock market's gone up. Economy looks fairly solid right now. And so this is probably the most encouraging of the BRIC countries when I look at it. But again, watching the currency, you can see here again that there was a big spike in 2013 as the Fed started to talk about tapering. And so something definitely worth watching going forward. Going to slide 28, Russia, no real reason to talk about this. Obviously, with what's going on with Ukraine, slide's pretty self-explanatory, and their currency is obviously depreciating and in a free fall at that point. So if I go to slide 29 to really summarize, the question you have to ask yourself is, how addicted to the current liquidity era are we? We've had zero interest rate policies. You could argue that these low rates caused the housing bubble in 2008 and the tech bubble in 2001 and 2002. So the question is, what bubble has it caused this time around? Are we seeing it in the currency markets, in the housing markets, in the equity markets in terms of the stock prices having roughly tripled off their lows in the U.S.? And how's this going to affect us in the future? The good news is the ECB is going to be expanding their balance sheet again from 15% of GDP back to around 25% or so. Japan continues to stimulate, though you have to remember the Bank of Japan's balance sheet's over 50% of GDP. And how much more benefit can you possibly get from this when you've put so much stimulus into the system already? Moving to slide 30, I'm not going to spend much time on this, but it's amazing the rapid rate that we've seen the World Bank cut forecast for global growth, the World Trade Organization in September, the World Economic Outlook from the IMF in early October, and then Germany cut their own GDP forecast just a couple of weeks ago. And Q2, as I said, was negative. Q3 is likely to be negative, which is the definition of a recession for Germany. So we'll have to see how that affects things. Going to slide 31. So what I'm going to talk about for the next few minutes, because Jody, I think, has done a really good job of laying out the importance of semiconductor in the global economy, is trying to look at some of the other macro drivers of semiconductor demand. So if I go to slide 32, the good news is profits in the United States, which is the orange for the S&P 500, is doing very well. That tends to drive business investment, which is the green. If I go to slide 33, the bad news is, you could argue, for the last couple of quarters, and I actually previewed this a couple of months ago when I had to give the last GSA presentation, but we've seen it now in terms of companies coming out and talking about a correction in the semiconductor industry. I think for the last 6 months we've really been over shipping demand. The concern I have, I know a lot of the majority of companies are calling for a shallow correction. I am concerned it's going to be much deeper than a shallow correction because of some of the factors we've talked about for global GDP growth. If the demand's not there in the fourth quarter, there'll be a lot of or more excess inventory than people are imagining, which will need to be cleared in 2015. So I would say I'm in the camp of a little bit deeper correction than most are calling for, that potentially extends through Q1. It's not for necessarily all end markets, but that's how I see it on a more a broader basis. Because if you kind of just visually look at this slide and then think about the GDP slides we've seen earlier, there does seem to be a little bit of a disconnect in terms of what this slide seems to show versus some of the earlier ones. Moving to the next slide, slide 34. The good news is we haven't really spent a lot on CapEx over the last 3 years. It was negative in 2012. It was barely positive in 13, up about 10%, 11% or so this year. So I don't see there being really a big concern in terms of oversupply, and that's when you really run into trouble. If you look at the late 80s, you can see, CapEx was up over 100%. If you look at, the 1995 time period, you can see CapEx was up over 60%, 2000 up over 80%, and so on. The good news is if we are going into a correction, it's not going to be a big supply problem. It'll be more of a demand problem. So the depth of the decline shouldn't be nearly as severe because we just don't have that much in terms of CapEx that we're spending. And the good and the bad news is Moore's Law is making it so the output for every dollar spent is a lot less. So that at least will keep the supply side under control, even if demand does fall off. Moving to slide 35, the communications industry, this looks at inventories and orders. So it's what every company looks at, except you can look at it on just in terms of the entire U.S. economy. This is data the government puts out. And you can see back here in 2000, it always amazes me when people say, well, we couldn't see the tech bubble bursting. Well, if that's your orange is your inventories and green is your orders, and the orange is going up and your orders are dropping, to me it's not that hard to predict you're going to have a big bubble breaking. The good news is if you look at today, again, things don't look that out of whack. So I think this is going to be a shallower correction, but it's likely to last through early next year. Going to slide 36, the one area that concerns me is the computing industry, because if you look at the orange, which is inventories, and you look at the orders, which is in the green on slide 36, you can see that there's a pretty big disconnect starting to develop. Whether that was just buying for Windows XP, so some of you may remember the Y2K bubble that we had, whether that spurred some extra spending that's going to drop off or not, we'll have to wait and see. But I don't like to see inventories at these levels when orders aren't going up with it. Going to slide 37, The one area that I feel probably the best about in terms of big end markets is automotive. And whether it's driverless cars, my mother is in her mid-70s. She doesn't like to drive. She's had eyesight surgery. The population of the globe is getting a lot older. I also happen to have teenage sons, which scares me to death when they start to drive in a couple of years. It'd be nice to have cars that can drive themselves. And I see this as a very, very big positive for the semiconductor industry in the future as we head towards driverless or automated cars. And going to slide 38, when I look at device growth, the good thing is that it's not just the PC driving the semiconductor industry anymore, and it hasn't been for a number of years. The bad news is that what we've seen back in 2013, where you had tablet growth of over 50% and smartphone growth of 40%, those have slowed down quite dramatically as we think about 2014. In fact, those growth rates, when you combine the units, has really been cut in half for combined tablet smartphone growth. And so adding all of these units together, you're sort of going from 10% unit growth in 2012 down to about 3% this year. And at this stage, I would say that the risk is more to the downside in 2015 than it is to the upside. But the good news is that there's still, growth going on, and that should help absorb the supply that's coming into the market. So going to slide 39, when I think about 2015, it's probably the most unpredictable year in my mind, really, since 2008. You have a lot of different cost currents. While the U.S. is going through tapering and removing stimulus, Japan continues to stimulate. The flip side of it is you have slowing growth in Brazil, Russia, China. India, thankfully, is growing, but it can't really offset some of the slowdowns we're seeing in some of these other regions in terms of rate of growth. We have emerging market inflation in some countries like Brazil. On the flip side, we've got a recession in the EU. And so when you think about this, I think it makes this one of the toughest years to potentially get through that we've seen in a very long period of time. The good news is, as Jody went through in her report, semiconductors are really driving global growth. There's new areas that I think are very exciting. The fact that I can do this presentation from San Francisco, it seems to be coming across pretty loud and clear in Taiwan, just gives another example of the power of semiconductors. And without them, this would not even be possible. Cloud computing, I think, is a new way of doing business that's driving a lot of demand for data centers as well as security spending. LED and solar, I think, are also very interesting as we look out towards the future, especially as solar now doesn't need as much subsidies to drive growth. Automotive, we've talked about, I think, driverless cars. There's a lot of really good things that's going to provide for a population that continues to age. And I think lower energy prices and an improving job picture should really help the holiday season in the U.S. And even though I think the Internet of Things is probably overhyped in the near term, I think looking out longer term, it's going to be a good thing in terms of especially monitoring people's health looking forward into the future. So the risk I see in the short term is that we're likely to enter a correction going into 2015 or coming out of the third quarter into the fourth and into 15. I think the opportunity, however, is that semiconductor vendors continue to become more important and strategic partners to a variety of industries, including cloud service providers, hyperscale vendors, and I think that's going to be a good growth driver for multiple years into the future. And finally, going to slide 40, I think there are a lot of people out there that have some very old devices and who need to upgrade. And these are my kids, and I can tell you they're after an iPad, or at least the hand-me-downs from my wife and myself. And this is a very old picture, but I can't bear to update it because they were pretty cute back then. So with that, I will turn it back over to Jody to poll for questions.
Thank you very much, Dan, for the giving us the most updated status of the global economics. So to prove that we actually are not a pre-video conference, so we are going to take some questions from the floor. Any questions to Dan?
Okay. As the chair, I got to ask. But then, I think it's great talk, okay? Give all the perspective on the economy over the world. You know, in the semiconductor GSA, we have a market executive rating or something. It has already been three months going down. What's the last number? I think 42, right? 47? So in GSA and semi, we are really probably feel ourselves like at a crossroad. So in your talk, I think currently we found that China getting weak. And you showed the house problem. And also you showed the bank problem. Can you elaborate more? How will their economy link to the world as an economy? And how will that economy affect the semiconductor? Can you comment on it?
Sure. I think the problem with China is that it's very hard to necessarily place. These are official numbers in this presentation. I think if you talk to a lot of companies, you'll find that their view is that these official numbers overstate the growth rate in China. And for a lot of the companies that I'm dealing with, so you actually understand. If you go back a couple of months and look at my prior presentation before Microchip came out and pre-announced negative results, I was already talking about things getting a lot worse. I think with China, it is actually one of the bigger risks because, and you're seeing it in a lot of different things, whether you look at their electricity consumption, which I like to watch, you look at what's going on with steel prices where they're consuming, or coal prices, where they consume an inordinate amount of the global output. This is not just a problem with semiconductors, it's a problem with commodities across the globe. And so I think the big issue is, unlike the United States, and if you believe the U.S. has the most developed banking system in the world, it should scare you in terms of the bad debts in China, in the sense that their economy isn't, or their banking system isn't as robust as in the U.S. The good news is China has a lot of currency reserves. So unlike in the U.S., that provides a huge buffer. It's very hard for me to see there being a banking crisis. But to your point, my big concern is that China demand continues to slow a lot more than people have in their numbers. I think U.S. in the fourth quarter, it'll be very interesting to see what dominates, whether low energy prices, rising wages, more jobs helps to drive a good retail fourth quarter, or if the fact that every region that S&P 500 companies are trying to export to, which is, I think, 40% of S&P sales go outside the U.S., whether that's going to drag growth down. And obviously, for the U.S., we get a lot of goods manufactured in China, and that's another way that China gets weaker. So unfortunately, I wish I could say that I thought that China data would get better. I think the one positive is that China's refusing to a large degree to stimulate recklessly, and we can argue what reckless means, but they're not willing to cause more structural imbalances. What they're actually trying to do is stimulate more internal consumption, export a lot less to improve their economy in the future. And I think that that's a very, very good thing. You don't want to be reliant on the rest of the world to drive your economy. And they're trying to reorient the economy in that regard. The bad news is that sometimes those adjustments can be pretty painful. And I think that's what you're seeing. Because I mean, if we go back to that slide, you can kind of see it. And actually, I don't know if whoever's running the slides can go back to slide 13. But what you can see here is that, really since that 2009 time period, I mean, the growth has just been going down and to the right. And I would argue this probably overstates it. So, yeah, I am concerned about this being a big drag on growth in the fourth quarter into Q1.
Okay. Any other questions?
Hi, Dan. My name's Dave Dutton. Just a question, and really a good comprehensive talk, but also I think recently about 10% of the German banks failed stress test. I think I saw that note.
Yes.
And so
Yep.
do you see that as causing a ripple effect through the rest of the banks in Europe, and will that accelerate or deepen a recession with Germany?
No, I mean, here's the thing, Dave. The good news is that the stress test in Europe was credible because they had stress tests before, and quite honestly, the amount of stress that they inflicted wasn't nearly enough. So people looked at the stress test and said, okay, this is a real stress test. They put real conditions in place that made sense. The number of banks that failed actually was about what people thought. So the good news is there were no surprises. People knew that there were going to be a bunch of bank failures. This had been telegraphed. So people weren't that upset. And the good news is, unlike back in the Lehman days, what the government's making these banks do is then go out, raise capital to shore up their balance sheets. Because the problem comes when a bank thinks that they're fine, like a Lehman Brothers. They don't raise capital when they need it, and then all of a sudden it goes to zero. And then you have a ripple effect, which was the term you used, which is accurate, because Lehman Brothers, when it went out of business, and I used to work at Lehman Brothers, had $600 billion worth of debt. So that means that there were people owed $600 billion that weren't going to get paid back. That's a big problem. The good news is with this ECB bank tests, the banks, they figured out which ones have the problem. Some of them actually already went through and got in front of this because they knew they would fail, and so they've been proactive in terms of trying to raise capital. So I think the good news is that the banks are actually in pretty good shape in Europe on a relative basis. What I'm actually more concerned about is in China. China allowed the first ever defaults this last year. The good news is they can keep bailing out, these loans for as long as they want with the currencies they have in reserve. So it's unlikely that becomes systematic, but those are the banks that probably have the most issues. The good news is the government has so much in terms of reserves that it'll probably never get to the point, hopefully, it'll probably never get to the point where it becomes a bigger issue. Having said that, obviously, as we saw in that slide earlier, Shibor shot up to 8% in a very short period of time last summer, so something to keep in mind. There's actually a slide I didn't put in here, which in hindsight I could have, but to your point, it does show how borrowing costs have started to go up in some in areas like Greece, for example. So the European banking crisis, the good news is that it's not as severe. It doesn't appear to be as severe as it was before, back in 2010. But there are certainly some problems with banks in Greece, for example, or Cyprus, et cetera, and even in Germany, obviously. You have to pay attention just based on who they lend to, but I feel pretty good about that for now.
Okay, so thanks again for Dan's exceptional insight, and hope you can join us on site next time.
Thank you very much. I look forward to being there. Thanks, Jody, so much for inviting me, and thank goodness for semiconductor chips to make this possible.
Thank you. Okay.